Let's talk to Bill Blain. He is a strategist at Mint Partners. Very good morning to you, young Bill.
Good morning. It's good to be called young.
Well, I do my best. Right, this is your rants. This is your soapbox. Ping 6 minutes. What's on your mind?
Today, we're sitting on the 10th anniversary of the collapse and subsequent rescue of Bear Stearns. It was actually the 14th of March. Today, of course, the 15th, the Ides of March. But 10 years ago today, the implications were becoming abundantly clear as to how bad the situation had got in the States. It's interesting also that last night, President Trump appointed his new director of the National Economic Council, replacing Cohen, who, of course, he fired famously last week. And his choice was Larry Kudlow, who was chief economist of Bear Stearns when I joined Bear Stearns in the early 1990s.
Wow.
It's, there's something symmetrical about it all.
Full circle.
But here we are, 10 years after the collapse of Bear. We've got one of their chief economists now taking over advisory work on the US economy, and we're wondering, where do we go from here? Is there a risk we could see the same thing happen again? The world is very, very different to the situation we faced 10 years ago. If you think back, and those of us that are old enough, and you and I certainly are, we had a situation where consumer debt was massively inflated. It was all concentrated in the mortgage markets. We saw the collapse of money markets when people started to worry about how much banks were lending, and the money markets drew up. That caused the collapse of banks like Northern Rock here in the UK, which were funding themselves short and lending long. And most of the collapse was concentrated in the banking sector, leading to first Bear Stearns, very nearly the rest of the US investment banking sector, most famously Lehman Brothers going down later in the year. Could the same thing happen again? Well, as I said, the markets have changed completely. Most of the risk that used to be concentrated in the banks is now spread across a much wider constituency. We've seen institutional investors, ranging from insurance companies to pension funds to credit investors and hedge funds, step in and take much of the risk that has been unloaded from the banks and has been forced out of the banks by new banking regulation. But that doesn't mean that risk has disappeared. That risk is very much still
Moved
there.
around the balance sheet.
Now, we've got a situation in the world today where we know even the new Fed head, Jerome Powell, admits that asset valuations look to be very high. We know that in the last 10 years we have not had inflation in the consumer or industrial markets. We've had it in financial assets. Stock prices are extremely high. Bond prices are extremely high. What happens when that starts to correct? It won't be in the banks that we saw last time. It's going to be across the whole of the investment sector. Do we have the same kind of risks that we've had before? As I said earlier, the risks have been spread much wider. We have a far wider constituency of holders of risk. But if we do see a correction in markets, because of some underlying fear, perhaps triggered by a trade war, whatever, then it's going to be far wider in the number of people who are hit. We're going to be talking about guys like ourselves that have our pension funds invested with the big insurance companies. If we see a major correction, that big pot that you're expecting to take in a few years' time might be a damn sight smaller. There is that risk, and that is the kind of real risk that I think the markets face today. It's not a collapse of a single thing, such as we saw 4 weeks ago with the volatility crisis, the VIX crash in early February.
Yep.
What we're talking about here is potentially a massive collapse in underlying confidence if the stock markets and bond markets were to unravel. Now, is that a big risk? Yes, it's a significant one. Because if you take a look at the other side of the equation, which is not the markets, but the politics, we've got a very uncertain world. Trump, of course, everybody assumes that it's the number of resignations that we're seeing, the number of people getting sacked, suggests a very, very weak US leadership. In fact, it's completely different. We've got Trump, who has made a statement that he wants people like himself round about him. And I think the world has failed to appreciate just how clearly Trump has set his agenda. He is beginning to get things done. He's hampered by the fact that the structure of the US leadership, the executive being controlled by Congress and the Senate and the separate judiciary, that system makes it very difficult for him to deliver, but he is getting things done. We've seen the tax cuts. We're going to see fiscal spending, but we're also seeing him address where he saw the big weakness of the US economy, its weakness to intellectual property being cannibalized and hijacked and pirated by countries like China. He's actually addressing these things, and the whiffs of trade war that we can smell just now are going to result perhaps in a very changed environment. He's also appealing to the political force for change. That's why he got elected. And we'd be unwise to think that the US is completely out of control. We'd also be unwise to ignore what's going on in Europe. We've got a very different situation in Europe just now. The Italian elections went pretty much as we expected, but we've got the situation where we have a weak German government that is forced to do deals with the rest of Europe to stay in power. We have a changed political situation, we have a changed market environment, and I think that means that the risks that we need to assess are very, very different. We also have very different government policies coming through. We've had 10 years of, how do you put it, experimental monetary policy, unconventional, QE, which is the major reason we've had inflation in the financial asset markets. We are now going to get unconventional fiscal policy as well. We've got a situation in the States where rates are still very low, yet we are cutting taxes, which is going to stimulate the economy. That doesn't happen often, where you get an economy that's heating up being further stoked by tax cuts, and I think we're going to see that elsewhere. So as an investor, you need to balance up really three sets of risks just now. One, there is the risk of politics. Secondly, there is the risk of understanding where risk is held within the markets. And the third thing, of course, is geopolitics. Now, where do we go from there? It looks like the global economy is remaining in recovery mode. If we can keep this balance between these three forces together, then it's very investable. The risk is that suddenly it isn't so.
Bill, on that note, fantastic stuff. Thank you.
Thank you.
Thought-provoking as always. That's Bill Blain. Thank you.